Hey everyone, and welcome back to the channel. My name is Hamish Hodder, and today we're going to be looking at Old Dominion Freight Line, which is a company that many of you may not have heard of before, but it is a company that I've spoken about on the channel before. So I thought that I would go back and sort of do an updated valuation, because a long time ago on the channel, I did a full stock analysis of this company. It was a company I was looking into, and I thought, you know what, I'll go ahead and make a video on this and break it down. Now that video was put together, it was okay, but it wasn't put together very well. The quality of the video and audio itself is pretty terrible, so that aside, plus the fact that I've done a lot more research on this company since then, I thought, you know what, I'll go ahead and do another full stock analysis. So that's what you can expect in today's video. And if you're new around here and you haven't seen these kinds of full stock analysis videos, then what you can expect is we'll start off with a breakdown of the company itself, sort of give you an overview of what Old Dominion Freight Line is. And then we jump into the main areas of analysis that we need to look at every time we're analyzing businesses to find good investments. And that means that we're first going to have a look at the industry of the business, its competition, having a look at the sort of the factors surrounding the business and what are some of the key factors that are important to analyzing this specific business. Then we want to have a look at whether or not this company has an economic moat. So an economic moat is some kind of long-term competitive advantage, and we're trying to identify that within the business. And we do that in a number of different ways throughout the video. Then we need to have a look at management, and we look at management in a few different ways: their skill at investing, their integrity, and a few other things. And then of course, towards the end of the analysis, we're going to do an intrinsic valuation, which means that we're going to estimate how much cash we can get out of this company over the next 10 years, and therefore work out how much to pay, because we need to know how much we're going to get out of this company. And that's ultimately what we're doing with this analysis. We're trying to find companies that are easy to estimate how much cash we're going to get out of them. We then try and estimate that cash, and we try and pay a price that is significantly lower than what we're going to get back. And that way, we're very likely going to make a satisfactory return. So if you do enjoy the video, please leave a like and share it with a friend. I really appreciate it. Those two things help out a ton. Let me know your thoughts down below. And of course, if you're new, hit subscribe and join the team. But for now, let's jump into it. So just to get started, I want to give you an overview of what Old Dominion Freight Line is. And essentially, they operate in the shipping industry, but in a subsection of the shipping industry, which is essentially called the less than truckload freight industry. So in the shipping industry, of course, that includes all kinds of different shippings. There's small parcels, there's express shipping, there's large freight shipping, and one of the segments is less than truckload. And essentially what that means is that within one of Old Dominion's trucks, there will be shipments from multiple different customers. Rather, that can be compared to truckload shipping, which is where the trucking company ships an entire truckload of a customer's product from one place to another place. So it's end to end, whereas that is not what Old Dominion does. What Old Dominion does is less than truckload. And when they do less than truckload, it makes things a little bit more complicated, because they're not just going from one point to another point with one customer's cargo, and because they're going from one point to many different points with many different customers' cargo, it means that they need a system, a network of service centers in order to process those shipments and make sure it gets efficiently to all of the correct places. And essentially, you could think of this as a good thing and a bad thing. The negative side of that is that it's very capital intensive, because they need to have more trucks, they need to have more service centers, and they need to spend more money investing in technology in order to get that their network being as efficient as possible. Compared to, say, a truckload driver, you could imagine there could be a business that just has one truck and one driver, and they just ship a customer's products from point A to point B with one truck. That's very easy. But alternatively, on the positive side, less than truckload is a very difficult industry to break into, and it's very difficult to compete against companies that are already established, like Old Dominion. Old Dominion is the 4th largest in the US, and the other ones include things such as FedEx. FedEx also does freight. So it's very difficult for new entrants to enter the market, and that kind of plays into Old Dominion's economic moat as well, which we'll talk about a little bit later in the video. In every business that we analyze, we need to make sure that we're identifying and understanding the key business indicators that go along with that business or industry. Every business has its unique indicators that can be used in order to assess the performance of that business in that specific specific industry. So let's zoom in on one of the key business indicators for Old Dominion, and that key business indicator is revenue per hundredweight. Now you might be wondering what that means, and essentially we're assessing how much revenue Old Dominion produces per 100 pounds of freight that they're shipping. So of course, if Old Dominion is making more money, generating more revenue per 100 pounds of freight that they're shipping, then that's going to be more cost effective for their trucks. If they're able to ship heavier items and pack more heavier items into their trucks and also charge more for those heavier items, then they're going to be able to generate a much larger amount of revenue than if they were generating a much smaller amount of revenue per hundredweight or per amount of weight in freight that they're shipping. So this is one of the key business indicators. It's certainly not the only one, and it needs to be used in conjunction with the other key business indicators that are associated with this business. And I actually just released the full stock analysis report and presentation for Old Dominion Freight Line in my private investing platform, Learn by Example. So if you're interested in learning more and sort of diving deeper into the analysis process, and you already have a basic foundational understanding of how to analyze businesses the value investing way, then you may want to consider joining. And if you are interested, then click the first link in the description below, and it's going to take you to a video where I explain what kind of people I work with, as well as the 4-step process that I use to analyze every business. And through that video, you can apply to have a call with me, and we can work out whether or not you're going to be a good fit for the community. So if you're interested in getting access to this report, the full report, presentation, and of course all of the other ones that I've done, there's about 10 hours of reports and presentations already in there, then click the first link in the description and join up for the platform, or apply to join the platform, I should say. But moving on, let's have a look at economic moat, where we need to start identifying competitive advantages that are unique to this business. Something that's unique, something intrinsic to the business that's allowing it to beat other businesses in its industry. And one of the key characteristics that gives Old Dominion an advantage over other businesses in its industry are that they can consistently produce faster and more reliable services for freight delivery services. Management believes that the transit times for Old Dominion are faster and more reliable than the other national competitors due to their highly efficient service center network, use of driver teams, and proprietary technology. These characteristics can be classified as branding and secrets economic moats. And once we've hypothesized about whether or not we think that a company has a competitive advantage over other businesses in its industry, we then need to look at the numbers and see if the numbers tell us that they have an advantage. Because at the end of the day, if they do have advantages over other companies in their industry, then they're going to be consistently generating more revenue and producing more profit. Because if they have an advantage, it means that they're going to be taking customers from their competition, which means they'll generate more revenue, and they should be able to operate more cheaply than their competitors. They should have lower costs than their competitors, which means that they're able to consistently generate more earnings and more cash flow. And if we have a look at Old Dominion's numbers, we can definitely see that the numbers support the contention that they do have a wide economic moat in one or more ways. Sales growth over the long term has been 10% and growing each and every year. Earnings per share has been 13%, again growing each and every year. Many of those years are above 25% growth. Equity growth has been 17% over the long term. Again, it's been pretty consistent over that time, 17-16% every year. Free cash flow, besides a couple of negative numbers over the very long term, has been growing at a huge rate. And cash flow for owners, which is free cash flow excluding growth initiatives, has been growing at 20% per year over the very long term and pretty consistently at that rate. So once we've identified that the business does have some kind of long-term competitive advantage or multiple long-term competitive advantages, we then need to move on to management, because at the end of the day, management are the ones that are going to be making decisions on behalf of us. They're deciding what to do with new profit. Do they take that new profit, that new cash that they've received from last year? Do they reinvest some of it? Do they pay it out? Do they do buybacks? Do they keep it as cash? Do they take on debt? All of these decisions over the long term will impact how much money we can pull out of a business over the long term. So we need to make sure that not only do we trust management, but that they are effective at investing within the business. Now, traditionally, we will assess this in terms of integrity, their skill at investing, and having a look at their debt. But in the interest of time, we will just zoom in on their ability to generate a high return on invested capital. Having a look at the ROIC, which I have calculated as cash flow for owners divided by long-term debt plus equity, you can see that over the very long term, in terms of their 2009 and 2010 return on invested capital, they were below our minimum benchmark of 10%. And that was due to the recession. Of course, their investments didn't go down too much during the recession, but their earnings were substantially hit during the recession. But coming out of the recession, every other year since 2011, they've had a substantially higher than our benchmark ROIC. In many years, their ROIC is above 15%, and in 2018, their ROIC was almost 25%. And seeing a company like Old Dominion consistently generate more than 15% or 10% or even 25% returns on their investments, while also consistently investing over that period, investing a lot of money in the business, that gives us confidence that they're going to be able to take their free cash flow and reinvest it, chuck it back into the business, and generate even more profit and grow their profits. Over the past 10 years, Old Dominion has invested about an additional $2 billion. That's $2 billion that they've invested. And even with investing an additional $2 billion, they've been able to increase the percentage return that they're generating. And in 2018, that was 25%, which is really, really impressive. And this will play a role in our intrinsic valuation. So let's get to the intrinsic valuation. Let's start to estimate how much cash we can expect to get out of a company, and therefore how much we're willing to pay for it. Now, traditionally, what I would do is I would come up with a number of different models with a number of different growth rates, potential growth rates that they could grow their earnings at or their cash flows at over the next 10 years. And that way we will get a range at which intrinsic value is likely to sit. And from that, we can work out how much we're willing to pay based on what return we want to make. So if a company is going to bring us in maybe between $100 and $200 per share over the next 10 years, then we can work out maybe we're willing to pay $50 for that. If they generate $200, that's going to be fantastic. And if they only produce $100, then that's also going to be fine. In the interest of time, we won't do a range of models, but we will just pick one model, and I'm going to use it as an example of what a potential intrinsic value for this company could be. Now, this certainly is not a recommendation of a buy, sell, or hold recommendation or advice based on this business. This is just an example. It's just a stock that I picked so that I can show you my analysis process, and so that you can apply that process in your own time to any business that you're looking at, whether it's Old Dominion or some other kind of business. So in order to do our intrinsic valuation, we first need to calculate the cash flow for owners in 2018. And once we've done that, we then need an estimation of what growth rate we can grow this company at over the next 10 years. Now, I normally do a range, but let's just do one model. And one example of a model could be using 12.7% growth over the next 10 years. And the reason that I've picked that number is because that is the historical revenue growth rate for the past 20 years for Old Dominion. So that is one of the models that we could use for the top end of our range at which intrinsic value is likely to sit. Using a growth rate of 12.7% and the starting cash flow for owners in 2018 of just under $700 million, that gives us an intrinsic value for the entire company of $27.4 billion. And using a 22% discount rate, that would mean that we would be willing to pay per share of about $85.52. Now, according to this model, which granted is a strong model to be using for this company, I certainly wouldn't be using this as my expected growth rate for this company. This would be a top end range. But according to this model, that means that the intrinsic value is about $27 billion, while the company's value at the current time is about $11 billion. So that means that it's at about a 50% discount to the current intrinsic value based on these metrics that we're using. Although, to be clear, I would not be using this as an expected growth rate for this company. This is a top end growth rate. This would be a really good achievement if they could do that. But when we're targeting a 22% return, we don't just want to pay 50% of intrinsic value, we want to pay substantially less. And in this case, it's about $85 per share, while the current stock price is about $140 per share. So we would still need to see about a 30 to 40% drop in the stock price for it to be a buy under this model if we're targeting 22%. 22%. Now, of course, you don't have to be targeting a 22%. That's what I personally target because it gives us a 15% return plus a 50% margin of safety. But at the current stock price, using that model that we just used, the expected return per year would be about 14% with no margin of safety. So if you had entire confidence in the growth rate that we used, which is 12.7% for the next 10 years, then you could expect to get a 14% return if you invested right now. But of course, as I said, I'm trying to get a 15% return with a 50% margin of safety, which means that I would want to pay substantially less than the current stock price. And in this model's case, it would be between 30 and 40% less than the current stock price. I wanted to share the expected return in this video of 14% for this company and this model specifically, because a few of you were getting mad at me because my buy prices were always substantially lower than the current stock price. And that's because my buy price is when I'm targeting 22%, and 22% is a huge return. And we're not going to see that every day. We're going to see that very rarely, usually if there's a recession or there's something seriously concerning happening in the particular industry. Now, that 22% return doesn't mean I always wait for that, but that's a return at which I would be 100% confident that I'm going to make 15%. So I've showed you what you would need to pay using this model. Remember, 12.7%, it's a big ask, so this isn't a recommendation, this is just one of the models that I'm using. But doing the maths and following the maths, if you're targeting 22%, the buy price would be about $85. And at the current stock price, you would expect to make about 14% using the assumptions in the model. So if you want to go ahead and use this model and change the assumptions, maybe you think that growth rate is too high. I certainly think it's too high for an expected return. If I was being conservative, I'd be using one much lower. So if you want to go ahead and mess with the numbers and that sort of thing and check it out, then click one of the links in the description below and you can get access to my free spreadsheet, which is where I calculated all of the numbers in this video. It's completely free and you can chuck in the numbers and mess around with any kind of company that you want. But I hope you guys enjoyed this video. And if you did, leave a like and let me know your thoughts down in the comment section below, and share it and do whatever you want. Just interact with the video. Any kind of interaction, subscribing, clicking the notification bell, any of that stuff really does help out my channel, and I really appreciate it. And as I said, if you want to learn my 4-step process and you want to learn more about my investing platform, which is where the full reports of these and the full presentations of these stocks is, and where you can get sort of coaching from me in terms of analyzing businesses in the stock market, then click that first link in the description below. But for now, guys, I will see you guys in the next video.